Ever stared at your past payroll tax filings and wondered if there might be, hidden money lurking there, just waiting to be claimed?
Hmm.
Or maybe you've discovered a mistake and felt that familiar, like stomach-dropping dread of dealing with the IRS, thinking, oh no, did I mess this up permanently?
Yeah, that feeling's pretty common.
Well, what if I told you that confronting those past payroll errors isn't just about avoiding penalties? It's actually one of the most powerful and, frankly, often overlooked ways to recover significant overpaid taxes.
Absolutely. Or claim valuable credits.
Exactly. Credits that could inject a substantial amount of cash right back into your business. We're talking real money ready for you to reclaim.
That's absolutely right. In the intricate and, let's be honest, sometimes overwhelmingly complex world of employer taxes, errors are not just possible. They are, well, to a certain extent, inevitable.
Everyone makes them.
Every business experiences them. But here's the truly good news. The IRS doesn't just leave you stranded. They provide a very clear, structured pathway to correct these missteps. And understanding this pathway, specifically through a crucial document known as Form 941X, isn't just about compliance. It's really a strategic tool for financial recovery and, incredibly smart tax management. It's about optimizing what you've already done, turning a potential liability into a significant asset.
Okay, let's unpack this immediately then. Why should an employer, whether you're a small business owner juggling everything or managing payroll for a large corporation, why should you genuinely care about correcting a previously filed tax form like Form 941? Is this just about avoiding trouble, or is there a much bigger financial upside?
Well, it's definitely about compliance and avoiding trouble. That's sort of the baseline,
Sure.
right? If you've underreported taxes, meaning you originally said you owed less than you actually did, correcting that promptly is essential, really essential.
Why essential? Just penalties.
Well, acting quickly in those scenarios allows you to avoid painful penalties, those dreaded failure to pay charges, and rapidly accumulating interest. The IRS is very clear they want you to fix it. But for many, the truly significant aha moment, the one that often brings a deep sigh of relief, comes when they realize they've actually overreported taxes.
Paid too much.
Paid too much, maybe. Or, even more commonly, they missed claiming a valuable credit they were absolutely entitled to.
Right. Like some of those COVID credits people missed?
Exactly. Or others. This is where Form 941X truly shines. It transforms from just a correction form into your key. Your key to unlocking a direct refund or getting a credit that can be applied against your future tax liabilities.
Which hits the bottom line fast.
Directly. Immediately. It impacts your cash flow in a profoundly positive way. It's about more than just avoiding a bad outcome. It's about putting tangible money back into your business.
So what does this all mean for you, our listener? It's not just about tidying up old paperwork in some dusty file cabinet.
Oh, definitely not.
We're talking about reclaiming money that can be reinvested into your operations, maybe cover unexpected costs, fund expansion, or just, improve your overall financial standing. It's a proactive, strategic step towards better financial health. Imagine what even a few $1,000s recovered from a past error could do for your business right now.
Exactly. Think of it like finding overlooked revenue. We often focus so much on generating new income, right?
Sales, marketing.
But optimizing existing tax liabilities, especially through corrections like these, is just as powerful for your bottom line. It's truly about financial optimization.
Building on that, let's really dive into the specific tool we're discussing today, Form 941X itself. What exactly is it, and what makes it so essential for employers looking to make these corrections and hopefully save some money?
Okay, Form 941X. Officially, it's known as the Adjusted Employer's Quarterly Federal Tax Return or Claim for Refund. That's a mouthful.
It is.
But it's specifically designed for employers to correct errors on a previously filed Form 941.
Okay, previously filed. That's key.
That distinction is absolutely critical. This form is not for filing a return for a quarter you simply missed entirely.
Right, so if you just forgot Q2, you can't use this.
No. If you forgot to file your original Form 941 for a given quarter, you need to go back and file that original Form 941 first. Form 941X is exclusively for when you've already submitted your initial return.
Maybe months ago, years ago.
Exactly, months or even years ago, and then later you uncover a discrepancy or a mistake. Something's not right.
So it's for rectifying what's already been reported, not starting from scratch.
Precisely. It's your mechanism for course correction. And one of the most critical aspects, maybe the most critical aspect to grasp when considering any correction, is what the IRS calls the period of limitations.
The deadline, basically.
Exactly. It's the specific time frame legally set by the IRS within which you can make these adjustments. Miss this window.
And you're out of luck.
You're out of luck. Even if you have undeniable proof that you overpaid or missed a credit, that opportunity for a correction is unfortunately lost forever. It's a hard deadline, not a suggestion.
So what are these crucial period of limitations rules that employers absolutely need to be aware of? How long do we actually have? Is it complicated?
The general rules vary slightly, depending on whether you've overreported or underreported. It's not too bad once you break it down.
Okay.
For overreported taxes, meaning you paid too much or didn't claim a credit you were due, you generally have 3 years. 3 years from the date you filed the original Form 941, or 2 years from the date you actually paid the tax reported on that Form 941, whichever of those two dates is later.
Whichever is later, that's helpful.
It can be, yes. Now, if you've underreported taxes, meaning you owe more, it's a bit more straightforward. You typically have 3 years from the date the original Form 941 was filed.
Okay, 3 years for underreporting.
The IRS refers to each of these timeframes as a period of limitations, and they are non-negotiable.
That sounds fairly straightforward on the surface, but there's often a nuance with tax states, isn't there? What about this filing date clarification I've heard about? Does that give you a little extra time?
There is, and it's a vital detail, something many employers might miss, potentially giving them more time than they realize.
Really? How does that work?
For the specific purposes of determining the period of limitations for these quarterly payroll tax forms, like Form 941, returns for a calendar year are always considered filed on April 15th of the succeeding year.
Always April 15th, even if I filed in January.
Even if you, as an employer, filed them much earlier than that official due date. This effectively extends your window to correct errors.
Okay, can you give us a real-world example? Maybe for Alex's tech startup, Horizon Tech Solutions. Make it concrete.
Certainly, let's use Alex. Imagine Alex with Horizon Tech filed his 2023 fourth quarter Form 941 way back on January 25, 2024. Very prompt.
Good for Alex.
Yep, well ahead of the deadline. All his payments were timely. Now, for the purpose of the period of limitations, the IRS treats this return as if it were filed on April 15th, 2024.
Okay, so not January 25th, but April 15th.
Right. Now, let's fast forward. It's January 29, 2027. During a detailed review, maybe preparing for funding or something, Alex suddenly discovers he overreported Social Security and Medicare wages on that 2023 fourth quarter form, let's say by, $3,500.
Okay, found money. How does he get it back?
To correct this error and potentially get that $3,500 back into Horizon Tech's bank account, Alex absolutely must file Form 941X by April 15th, 2027.
Because that's 3 years from the deemed filing date of April 15th, 2024.
Exactly. That's the absolute end of the period of limitations for that specific Form 941 quarter. If he files it on April 16th, 2027, even by 1 day,
Too late.
that opportunity for correction is gone. That extra bit of time, that April 15th rule, can truly be a lifeline, but it also means you really can't procrastinate once you find an error.
Wow, so that April 15th rule could be a lifesaver, but yeah, it still means you got to act fast once you spot something. This brings us to a rather important, almost a cautionary tale, doesn't it, about expired opportunities, especially for some of those big recent credits.
This is a critical point, a really critical point every employer needs to be aware of, especially given recent history.
What's specific?
It's vital to note that some corrections for specific past credits, particularly those incredibly valuable COVID-19 era relief measures like the Employee Retention Credit, the ERC,
Huge one.
massive, or certain qualified sick and family leave wages from 2020 and 2021, their periods of limitations have now expired for most employers.
Already gone.
For many, yes. For instance, the period of limitations for correcting qualified wages paid in the second, third, and fourth quarters of 2020 for the ERC generally expired on April 15th, 2024.
Wow.
For qualified wages paid in any quarter of 2021 for the ERC, that period generally expired on April 15th, 2025.
So that window closed recently for 2021.
That's right. This also applies to lines related to recovery startup businesses and the work opportunity tax credit for certain veterans. In fact, specific lines on Form 941X lines 18A, 26A, 30, 31A, 31B, and 32 are now officially marked as reserved for future use by the IRS.
Why?
Precisely because these periods have expired for almost everyone.
That's a harsh lesson.
It truly underscores a crucial lesson for any tax credit or relief program, past, present, or future. act quickly. Because these windows close, and the money is truly left on the table. If you miss that window, that money is simply gone.
So time is definitely of the essence when you spot an error that could mean money back in your business. It's not just a suggestion. It's a hard deadline with real financial consequences. A powerful reminder not to take any deadlines lightly, especially with potential tax savings.
Absolutely. Procrastination in this area can be very, very costly, turning a potential refund into just a lost opportunity.
What's fascinating here, though, is that even when you've identified an overreported tax amount, Form 941X doesn't just offer one path to fix it. It actually gives employers two primary processes, the adjustment process and the claim process. How do you decide which one is right for your situation? Is there some strategy involved?
Your choice between these two paths depends entirely on what you want to do with the overreported tax amount. Do you want that credit to be applied to a future tax period? To offset upcoming liabilities, basically reducing what you'll owe next quarter?
Like using it as a down payment on future taxes?
Sort of, yeah. Or do you want a direct cash refund, money sent back to your business bank account? Form 941X gives you that strategic choice, which is quite powerful, actually.
Let's break down the adjustment process first. That's checking line 1 on Form 941X, right?
Yes, that's line 1. You select this process if you've underreported tax and you need to pay the additional amount owed.
Okay, so it's for paying more, too.
Yes. And in this scenario, filing the 941X and paying the additional amount on time generally makes the correction interest-free and helps you avoid those failure to pay or failure to deposit penalties.
Oh, that's a huge benefit if you owe more.
It's massive, a huge incentive to correct promptly. But you also use the adjustment process if you've overreported tax and you want the resulting credit applied against your current or a future Form 941, or even Form 944 if your filing requirement changed to annual.
So for overreported tax using this adjustment path, how does that credit actually get applied?
Yeah.
Is there a smart way to file to make sure it goes smoothly? Avoid those, confusing IRS notices.
Good question. For overreported tax, the IRS will apply your credit on the first day of the Form 941 or Form 944 period, during which you actually file Form 941X.
Okay, the filing date matters.
It does. And this is where a strategic filing tip becomes really valuable, especially for businesses like Alex's. If you discover an overreported amount, particularly towards the end of a tax quarter like in March, June, September, or December, it is highly encouraged.
What should you do?
File your Form 941X in the first 2 months of the very next quarter.
Why them specifically?
Because doing so provides the IRS with ample time, usually enough time, to process that credit before your next regular Form 941 is due.
So they see the credit before they calculate the next bill.
Exactly. This proactively prevents you from receiving an erroneous balance due notice for your upcoming quarter, which can be super frustrating and confusing.
Definitely want to avoid those. Example.
Okay, so if Alex at Horizon Tech finds an error on, say, September 15th, 2025, for his 2024 fourth quarter return, he would ideally file Form 941X on, let's say, October 6th, 2025.
Beginning of Q4.
Right. This allows him to then confidently take that credit on his fourth quarter 2025 Form 941, knowing it should be processed and applied by the time that return is due in January.
That's a really practical tip. Avoids extra phone calls to the IRS. Any important catches or situations where you can't use the adjustment process?
Yes, there's a crucial one, a hard stop. You cannot use the adjustment process if the period of limitations for your original Form 941 will expire within 90 days of the date you file Form 941X.
Wait, why?
For an overreported amount. If you're that close to the deadline for claiming an overpayment, the IRS forces you onto the other path.
Which is?
The claim process. They want to ensure they have enough time to process and potentially audit a claim before that statute of limitations completely runs out.
Okay, that makes sense. So that leads us directly to the claim process, which is checking line 2 on Form 941X. When is this the right choice, and why would an employer opt for a refund rather than a credit? Seems like getting cash back is usually preferred.
You use the claim process only if you have overreported tax and you are specifically requesting a direct cash refund, or sometimes an abatement, which is like a cancellation, of that overreported amount.
So line 2 includes cashback request.
Essentially, yes. This option offers flexibility in that you can file a claim anytime before the period of limitations expires. The reason an employer might choose this path is simple. They need the cash now.
Right. Cash flow is king.
Or maybe they don't anticipate enough future tax liability to fully use up a credit quickly. However, as I just mentioned, if you're correcting overreported tax amounts within the last 90 days of that period of limitations,
You have to use this one.
You must use the claim process. It becomes mandatory in that narrow window. No choice.
This raises an important question, though. What if an employer like Alex is correcting both underreported and overreported tax amounts for the same tax period? Like, he owes more Social Security but overpaid Medicare. Can they just net it out on one Form 941X and tax? Or do they need separate forms? That sounds like it could get complicated.
That's a critical distinction, and yeah, it can indeed get tricky. If you are correcting both underreported and overreported tax amounts for the same tax period, and you specifically want a refund for the overreported portion,
You want cash back for the part you overpaid.
then you must file two separate Form 941X vary.
Two forms, really?
Yes, one form would be solely for the underreported amounts using the adjustment process, line 1, and a second, entirely separate Form 941X would be solely for the overreported amounts using the claim process, line 2.
Wow, okay. No mixing allowed if you want a refund.
Correct. You simply cannot mix and match for a refund on a single form. The IRS processing systems are just designed differently for adjustments versus refund claims. It needs to be separate. And it's also important to remember what you cannot claim a refund for through this process.
What's off limits?
You cannot file a refund claim to correct federal income tax or additional Medicare tax actually withheld from employees.
Why not?
Because those funds were collected on behalf of the employee. They belong to the employee, essentially. And they are generally claimed back by the employee on their personal income tax return, their Form 1040.
So the employee handles that part.
Right. Your Form 941X is for correcting your employer portion of taxes or maybe the employee portion that you overreported and now need to resolve directly with the employee first, not just clawing back their withheld income tax.
That makes perfect sense. It's clear that picking the right process, line 1 or line 2, and knowing the rules is essential. So how do I actually figure out what went wrong and what specific errors can I even correct using Form 941X? It feels like it's all about navigating those specific lines. But maybe we don't need to go line by line here. What are the common categories of errors? What should employers like Alex be looking for?
You're absolutely right. Let's focus on the broader categories and the key insights rather than every single line. Form 941X provides specific sections designed to correct various types of errors. Understanding these categories is paramount, right? Because it helps you pinpoint potential tax savings or, amounts you might owe.
Okay.
A general rule of thumb is this. If a section doesn't apply to your specific situation, just leave it blank. Don't force an entry. For the exact line numbers and detailed calculation instructions, you'll definitely want to check the IRS form, and instructions. We'll link those in our show notes.
Good idea.
Let's walk through some of the most common error archetypes, if you will, that lead to these corrections. First up, probably the most fundamental, correcting wages, tips, and other compensation. This broadly impacts lines 6, 8, 11, 12, and potentially 13.
Why fundamental?
Because it's the bedrock of your payroll taxes. So many other calculations like Social Security and Medicare taxes flow directly from this base number, get the wages wrong, and a lot else gets wrong too.
Makes sense. What kind of wage errors pop up?
Oh, several common ones. First, the double-counted wage. This happens more often than you'd think. Maybe you processed payroll, then had to rerun a segment, and accidentally included certain wages twice.
Ooh.
Yeah. So if Alex at Horizon Tech originally reported, say, $90,000 in total wages for a quarter, but then discovered he mistakenly included $2,000 in wages twice for one employee, his corrected amount would be $88,000. This directly leads to a tax reduction, less tax owed.
Okay, good error to find.
Then there's the opposite, the overlooked tip or commission. Sometimes tips or commissions, especially if they're reported outside of a standard payroll cycle, just get missed in the final tally for Form 941.
Like cash tips, maybe?
Could be. So if Alex reported $90,000 but later realized he overlooked $1,000 in tips that should have been included, his corrected amount is $91,000. This leads to a tax increase, more tax owed,
Right.
and a really big one, the misclassified benefit. This tricks people up. Payments like auto allowances, certain fringe benefits, or even some expense reimbursements, if they're not substantiated under a proper accountable plan according to IRS rules,
They're just wages.
they're actually taxable wages.
They're...
So if Alex paid $1,500 in auto allowances that he initially didn't treat as taxable wages, but later realized they were wages because maybe employees didn't have to track mileage properly, he would need to add this $1,500 to his total wages for that quarter.
And that affects everything else.
Exactly. It can have a cascading effect on all related taxes, Social Security, Medicare, potentially income tax withholding. And speaking of Social Security and Medicare taxes, that's our next category, lines 8, 11, and 12. These are directly tied to those corrected wages and tips we just discussed.
Rates are fixed, right?
Yes. The Social Security tax rate is 12.4% total. That's 6.2% employer, 6.2% employee. And Medicare tax is 2.9% total, 1.45% employer, 1.45% employee. So, following our example, that $2,000 decrease in wages from the double counting error, that would reduce the total Social Security tax owed by $248, 2K on 0.124, and the Medicare tax by 58 tax, 2K or 0.029 tax.
Okay, the math flows directly.
It does. But here's a crucial step, a really important procedure, specifically for overcollections of the employee's share of Social Security or Medicare taxes.
What do you have to do?
If you're correcting an amount where you overcollected the employee's share, you took too much out of their check, you must certify on lines 4 or 5 of Form 941X that you've either repaid or reimbursed the employees their share.
Give them the money back.
Right. Or, alternatively, that you have obtained their specific written consent to claim the refund on their behalf.
Why is it so important?
It's not just a formality. It's a very important safeguard. It protects your employees' rights to those overpaid taxes. You can't just claim the employee's money back from the IRS without their explicit acknowledgement. It often involves sending a corrected W-2, a W-2C, to the employee as well, showing the corrected amounts.
That makes sense. Protects everyone involved. What about federal income tax withholding and that additional Medicare tax? Those seem trickier.
They absolutely can be. Let's move to correcting federal income tax withheld, line 7, and additional Medicare tax withholding, line 13. These lines have a crucial limitation you absolutely must be aware of.
Okay, what's the catch?
For prior years, you can generally only correct what the IRS calls administrative errors.
Administrative errors. What does that mean exactly?
It means errors where the amount you reported on Form 941 simply wasn't the amount you actually withheld from your employees' paychecks, a typo, basically, or a reporting mistake.
So what can't you correct?
You generally cannot use Form 941X to correct federal income tax that was actually withheld in a prior year if you later realize it was the wrong amount because, say, you used the wrong withholding table or maybe misclassified a payment type.
Why not? You withheld the wrong amount.
Because the IRS considers that tax to have been collected and remitted on behalf of the employee. Any overwithholding is something the employee would typically address and get back when they file their individual income tax return, their Form 1040.
Ah, okay. So it's the employee's issue to fix on their 1040, not the employer's on the 941X, if the withholding itself was wrong but reported correctly.
Generally speaking, for prior years, yes. The 941X is for fixing your reporting or your employer tax calculations or dealing with employee share overcollections you need to refund to them first.
So give me an example of an administrative error for withholding that can be corrected on 941X. This distinction is really critical.
Okay, a clear administrative error. Let's say Alex at Horizon Tech actually withheld $9,000 in federal income tax from his employees during a quarter. But when he completed his Form 941, maybe a finger slipped, he mistakenly entered and reported only $6,000.
Just a reporting error.
Exactly. In a later year, he can correct this administrative oversight by reporting a $3,000 increase on line 7 of Form 941X. He's correcting his reporting error, not the actual amount that came out of employee checks. Similarly, for additional Medicare tax on line 13, if Alex correctly withheld $200 but accidentally reported only $20 on Form 941, that $180 difference is an administrative error he can correct.
Got it. Fix reporting mistakes, not past withholding decisions.
Right.
What about tax adjustments on line 15? What falls under that?
This line is used to correct specific adjustments that affect your overall tax liability but aren't directly tied to wages in the same way. Think things like adjustments for fractions of cents rounding.
Tiny amounts.
Can be. Or adjustments for third-party sick pay, or for the tax on excess group term life insurance provided to employees. These are often smaller, but still important. Corrections that might have been miscalculated or missed on the original Form 941. For instance, if an adjustment for third-party sick pay was too small on the original form, you'd use this line to increase it, which would typically lead to a tax reduction.
Okay, catches some miscellaneous items.
Exactly. And finally, we get to the potentially big one, employment tax credits. This broadly impacts lines like 16, 17, 18B, 18C, 25, 26B, and 26C. This is where significant tax savings or adjustments can really come into play. This is often where employers find they left serious money on the table.
Like what kind of credits?
Well, for example, the Qualified Small Business Payroll Tax Credit for increasing research activities on line 16, if you underreported this credit.
You didn't claim as much as you should have.
Right. This underreported credit is treated like an overreported tax amount. It directly leads to a reduction in your tax liability when you correct it. You would also need to attach a corrected Form 8974, the form used to claim that credit originally.
So finding an error there is direct savings.
Absolutely. Now, regarding the COVID-era credits like qualified sick leave, family leave, COBRA premium assistance, it's crucial to reiterate what we discussed earlier.
Like deadlines.
The periods of limitation for many of these credits have now passed for most employers. The window has closed.
Right.
However, if by some unique circumstance your period of limitations was still open when you discovered an error related to these, the Form 941X instructions detail the incredible precision involved. They talk about distinguishing between non-refundable and refundable portions of credits, properly allocating qualified health plan expenses. It gets complex.
Not it.
For instance, if you discovered you underreported the non-refundable portion of the sick leave credit by $1,000, you would enter this as a positive $1,000 difference in one column, which then, through the form's math, becomes a negative $1,000 on the final summary line, showing it as a credit reducing your tax balance.
Okay, the form mechanics handle that.
Yes, and for these complex credit calculations, the IRS even provides specific worksheets, like Worksheet 1, 2, and 3 in the instructions to guide you through the steps. But again, the main takeaway for most listeners now is that these specific COVID-era credit correction windows have likely closed. Check the dates carefully.
It sounds like the key overarching theme here is absolute precision and a very thorough understanding of exactly which categories of errors apply to your specific situation, especially if you're aiming to recover overpayments and really maximize those tax savings. It's not just a numbers game, it's a detail game, isn't it? Sometimes feels like detective work into your own past records.
It absolutely is. Every dollar, every line, every nuance matters. And just knowing what to look for, what types of errors are common, is honestly half the battle.
Okay, so we know what we might be able to correct. But beyond just knowing which lines to fill out, there are these crucial procedural elements, things you need to do to make sure your Form 941X actually gets processed efficiently and, most importantly, correctly by the IRS. What are the best practices for filing and completing this form? How do we reduce friction and avoid those dreaded delays or IRS letters?
Right. This is where attention to detail really pays off. Avoids unnecessary back and forth with the IRS. First and foremost, a simple but vital rule. Always file a separate Form 941X for each original Form 941 you're correcting.
One form per quarter being fixed.
Exactly. So if Alex at Horizon Tech found errors in both Q3 and Q4 of 2024, he'll need to file two separate forms 941X, one for Q3, one for Q4. Trying to combine them on one form will cause immediate processing issues.
Yeah.
Guaranteed.
Okay, separate forms. Got it. What else?
Basic stuff, but critical. Ensure your employer identification number, EIN, your business name, and your address are absolutely accurate. Double check them. And here's a neat tip. If your address has changed since you filed your original Form 941, entering the corrected current information on Form 941-BEX will actually prompt the IRS to update their records for you. So it serves a dual purpose, helps get your form processed, and keeps your main IRS account info current.
Handy. What about dates?
A very vital entry. The date you discovered errors, right at the top of page 1. This isn't just, a random date. It's the precise date you had enough information to reasonably know a correction was needed.
Why is that date so important?
This specific date is crucial because it influences whether your correction is eligible for that interest-free treatment we talked about, particularly if you're correcting an underreported amount. It starts the clock for timely filing.
What if I found multiple errors at different times?
Good question. If you're reporting several errors discovered at different times, you should enter the earliest date you discovered any of them here at the top. Then, you detail any subsequent discovery dates and the specific errors found on those later dates down in line 43, the detailed explanation section.
Okay, so earliest date up top, details below.
Right. Provides the IRS with a clear timeline of your discovery process. Now, when it comes to the numbers themselves, numerical entries precision is paramount. When you're reporting negative amounts, which represent reductions in tax or credits you're claiming,
use a minus sign.
Always use a minus sign. For example, minus 1,234.56. Do not use parentheses like accountants sometimes do, like 1S and 234.56. The IRS systems read the minus sign.
Okay, minus sign for negatives.
And crucially, always show amounts for cents, even if they are zero. So write 1,000.00, not just 1,000, or negative 50.00, not negative 50. This level of precision helps the IRS's automated systems process your form correctly and avoids potential flags or calculation errors on their end.
Got it. File electronically.
The IRS strongly encourages electronic filing for Form 941X. They use their modernized e-file or MEF system. This is generally much faster and more secure than mailing a paper form.
Plus you get confirmation, right?
Yes, you usually get immediate confirmation of receipt, which is invaluable for your records and peace of mind. Highly recommended if your software supports it.
Now, you mentioned line 43, the explanation section is all important. This sounds like it could be a real make or break part of the form. What exactly needs to go there to ensure a smooth process, to avoid those IRS letters asking, what is this about?
It absolutely is the make or break section. Treasury regulations, the actual rules, mandate a detailed explanation for each and every correction you make.
What's not good enough?
Generic statements like payroll errors or fixed wages or wages overstated are simply insufficient. They will almost certainly lead to processing delays. Why? Because the IRS will need to send you an inquiry, a letter, asking for a more complete explanation. That puts your entire correction, your refund, your adjustment, everything on hold.
So what do they need?
For each correction, you must provide the specific Form 941X line number affected by that error, the exact date you discovered that specific error, the precise dollar amount of the difference, the error amount itself, and, crucially, the cause of the error. Not just what happened, but why it happened, what led to the mistake. This provides the essential context for the IRS reviewer.
Can you give us an example of a really good explanation? The kind that Alex at Horizon Tech should write. Something that lets the IRS agent just say, okay, approved, without needing more info.
Absolutely. A good explanation, one that answers those key questions, would be something like this. Line 6, 8, and 12, correction. The latest $1,000 difference shown in column 3 on line 6, wages, 8, SOCSEC wages, and 12, Medicare wages, reflecting a decrease in reported amounts, was discovered on May 12, 2025, during our quarterly internal payroll audit. Cause of error. We identified that wages for employee John Doe, SSM XXXXXX, were inadvertently included twice in the initial Q4 2024 Form 941 filing due to a system glitch during a payroll software update on Jan 15, 2025. This resulted in overreported wages and corresponding taxes for that quarter. This correction removes the duplicate reported wages that were never actually dispersed to the employee.
Wow, that's specific: date, lines, amount, employee, cause, action.
Exactly. Clear, concise, and provides all the required information. It gives the IRS the full story so they don't have to guess or ask follow-up questions.
Okay, that makes sense. What about the certifications? Part 2, lines 3 through 5. Those sound important too. Legal attestations.
They are crucial legal attestations. You're signing under penalties of perjury. On line 3, you must check the box. You're certifying that you have filed, or that you will file, all applicable Forms W-2 and, if needed, Forms W-2C, the corrected version, with the Social Security Administration.
Even if my 941X corrections don't change the W-2 amounts.
Even if your corrections on Form 941X don't change the amount shown on those employee forms, it's a confirmation that your employer tax filings align with your employee wage records overall. Now, lines 4 and 5 become active and really important if you're correcting overreported employee taxes like their share of federal income tax, Social Security, Medicare, or additional Medicare tax.
The parts that came out of their checks.
Exactly. You have a very important legal duty here to ensure your employees' rights to recover their overpaid share of these taxes are protected. The IRS won't let you just take it back without addressing the employee.
So how do you protect those employee rights when you're claiming a refund or adjustment that includes their share? What does that process actually entail? What do you check on the form?
There are two main ways to handle this and certify it on the form. First option, if you've already repaid or reimbursed the employee's share of those overcollected taxes.
You gave them the money back already.
Yes. Then you must check a box, usually on line 4A or 5A, depending on the tax type. By checking that box, you are certifying that you've done this. And critically, you're also certifying that you've received specific written statements from those employees.
What did the statements need to say?
They need to confirm that the employee hasn't already claimed and won't try to claim a refund or credit for those same prior year overpaid taxes themselves directly from the IRS. Avoids double dipping.
And you keep these statements?
Absolutely imperative. You keep these written statements securely in your records, typically for at least 4 years, sometimes 6 years for certain old COVID-era leave wages if applicable. You do not send them to the IRS initially with the 941X, but you must have them readily available if the IRS asks for them during an audit or review.
Okay, so option 1, pay them back, get written proof. What's option 2?
Option 2. If you haven't yet repaid them, you must check a different box, usually on line 5B. By checking this, you are certifying that you've obtained specific written consent from each affected employee, consent allowing you to file the claim and get the refund on their behalf.
What needs to be in that consent form?
It has to be very specific. It needs the employee's name, their social security number, your EIN, the tax period involved, the type of tax, SOX Act, Medicare, etc., the exact amount of their overpaid tax, and their signed authorization statement under penalties of perjury allowing you to claim it for them.
And again, keep these records.
Keep these consent forms meticulously. Don't send them to the IRS unless specifically requested. The IRS wants to avoid situations where both the employee and the employer are trying to claim the same overpayment. These certifications prevent that.
Are there other certification options on lines 4 and 5?
Yes, a couple more specific situations. You can certify on line 5C that your overreported tax adjustment or claim is only for the employer's share. Maybe employee consent wasn't obtained, or perhaps you couldn't find the former employees after making a reasonable effort.
So you only claim your half back.
Right. Or line 5D is used if your overreported amount relates to taxes you didn't actually withhold from employees, but perhaps you should have reported differently, and you're now correcting your own reporting error related to that. Each box serves a specific purpose to ensure proper accountability and, importantly, employee protection.
Okay. And the final step?
The signature. Ensure the form is fully completed. All 5 pages need to be submitted, even if some are blank and properly signed by an authorized person. Typically an owner, a corporate officer, maybe a partner, or a duly authorized agent with a valid power of attorney, Form 2848, on file.
What happens if it's not signed?
An unsigned Form 941X is considered incomplete. It will be rejected or significantly delayed. It's one of the most common and easily avoidable reasons for immediate processing problems. Double-check that signature.
That's a lot of detail, but it really sounds like it's all aimed at making the process as smooth as possible if you've dotted all your I's and crossed all your T's. It emphasizes that while the IRS wants corrections, they definitely want them done properly and transparently.
Exactly. It protects everyone, the employer, the employee, and the tax system.
Okay, let's talk penalties and interest. Nobody wants those adding insult to injury when they're just trying to fix a mistake. How does Form 941X specifically help here? Especially if you realize you've underreported your taxes and actually owe more money. Is there a real benefit to proactively correcting it yourself before the IRS finds it?
This is a truly critical point for employers and honestly a huge incentive for being proactive. The IRS instructions are very clear on this. Your correction of an underreported tax amount will generally not be subject to those failure to pay FTP penalties, failure to deposit FTD penalties, or interest charges.
No penalties, no interest. That's amazing.
It's a tremendous benefit, but this interest-free treatment and penalty avoidance only apply if you meet specific crucial conditions. You have to follow the rules precisely.
Okay, what are the conditions? What do I need to do?
First, you must file Form 941X on time. Now, for underreported tax, on time means by the due date of the original Form 941 for the quarter in which you discovered the error.
Wait, say that again. The due date for the quarter, I found the error.
Yes. So, for example, if Alex at Horizon Tech discovered an error from a prior year back in August, which falls in the 3rd quarter, ending September 30th, he would need to file his Form 941X correcting that past error by the October 31st deadline. That's the due date for the Q3 return, the quarter he found the error.
Ah, okay. So it's about acting promptly based on the discovery date, not necessarily within the original tax quarter the error occurred in.
Exactly. Timeliness is based on discovery. Second, and equally important, you must pay the entire amount owed by the time you file Form 941X.
Pay when you file.
Correct. This isn't just about filing the form. It's about making the payment concurrently. If you file the form showing you owe money but don't pay it then, penalties and interest will still start to accrue from the filing date.
Okay. File on time based on discovery. Pay when you file. What else?
Third, you must correctly enter the date you discovered the error on the form up top, as we discussed. This serves as your official record of discovery for the IRS to verify the timeliness.
Got it. Date of discovery is key.
And fourth, you must provide that detailed explanation of the correction on line 43, fully detailing the grounds and facts relied upon to support that correction. Remember, no vague statements. Give the IRS the full story of why you owe more.
So meet those 4 conditions, and generally No penalties or interest on the underpayment.
Generally, that's the huge advantage of using the adjustment process proactively.
So it really pays to be diligent and proactive once an error is found. What happens if you file late for an underreported amount? Say Alex finds the error in August but doesn't file the 941X until December. Does he lose the penalty protection?
It gets more complicated then. If you file a Form 941X late for underreported tax, meaning after the due date of the return for the quarter in which you discovered the error, you likely lose the interest waiver. And you must attach an amended Schedule B, Form 941, to the late 941X.
Schedule B, why?
To avoid what the IRS calls an averaged failure to deposit FTD penalty. Without that amended Schedule B showing exactly when those additional tax deposits should have been made, the IRS might just estimate your deposit compliance based on the total underpayment and hit you with a potentially large FTD penalty, even if you ultimately pay the tax. The Schedule B clarifies the deposit timing for the corrected amounts.
Okay, so late filing for underpayments means interest likely applies, and you definitely need that amended Schedule B to avoid FTD penalties.
Correct. It's much better to meet the timely filing deadline if you can.
And are there any situations where this interest-free treatment isn't available at all? Even if an employer tries to meet all those conditions, like, are there red flags that would automatically disqualify you?
Yes, there are specific exclusions. These are generally designed to prevent abuse or address situations where the IRS is already looking into the matter.
Like what?
Interest-free treatment isn't available if the underreported amounts relate to an issue that was already raised in a prior IRS examination of your business. In other words, if they already caught it during an audit, you don't get the free pass by filing a 941X afterwards.
Makes sense. Too late then.
It's also not available if you knowingly underreported your tax liability, meaning there was evidence of an intentional act of deception or fraud, not just an honest oversight or mistake.
Okay, fraud negates it, obviously.
Right. And finally, if you've already received a formal notice and demand for payment from the IRS for that specific liability, or something called a Notice of Determination under Section 7436 related to worker classification, then the opportunity for this specific interest-free correction process has passed for that particular issue.
So if the IRS is already formally involved, the grace period might be over.
Exactly. These exceptions are really in place to ensure fair play and prevent intentional tax avoidance or repeated noncompliance. The interest-free provision is really geared towards encouraging good faith efforts by employers to correct genuine mistakes they discover themselves.
That makes a lot of sense. It encourages self-correction, which is ultimately what the system wants.
Yes, Lisa.
Okay, this deep dive has covered a tremendous amount of ground, breaking down a pretty complex Form 941X, and its many nuances. But for someone listening, maybe facing a really complex correction, or perhaps just needing a little more clarification on their specific situation, where can they go for more information or reliable help?
That's a great question because the IRS understands this can be a complex area, and they actually provide quite extensive resources to assist employers. You're not entirely on your own.
Where should they start?
Your first stop should always be online, as these resources are comprehensive and, importantly, constantly updated by the IRS. You can visit irs.gov employment taxes and also irs.gov correcting employment taxes.
Okay, those sound like good starting points.
They are. They have detailed online guidance, frequently asked questions, FAQs, links to forms and instructions, and the latest updates directly from the agency. These are really your primary hubs for self-service information.
What about publications?
You should definitely consult IRS Publication 15. That's the main employer's tax guide. It has a whole section dedicated to General Form 941 corrections and related employment tax matters. It's surprisingly readable for an IRS publication and contains many helpful examples.
And for U.S. territories.
For employers in U.S. territories, Publication 80 might still be relevant for older quarters, but it's worth noting that Publication 15 is now used by all employers, including those in territories, for tax quarters beginning after December 31st, 2023. So Pub 15 is becoming the universal guide.
Okay, Pub 15 is key. What if you need to talk to someone?
If you prefer to speak to someone, you can call IRS phone assistance. For general federal employment taxes and corrections, the number is 800-829-4933.
800-829-4933.
Right. And for persons with hearing or speech disabilities, the TTY line is 800-829-4059. These lines are generally open Monday through Friday from 7 a.m. to 7 p.m. your local time. Though there are some variations for Alaska, Hawaii, and Puerto Rico, So check the IRS website for exact hours.
Be prepared for hold times, probably.
Realistically, yes, be prepared for potential wait times, especially during peak seasons, but they can often provide direct answers or point you in the right direction.
And for making payments, if you owe money.
Of course, for making any payments for underreported taxes, the IRS offers several convenient electronic options. You can use the Electronic Federal Tax Payment System, EFTPS.gov. That's really the preferred method for businesses.
BFTPS, okay.
You can also use IRS Direct Pay for one-time payments directly from a bank account, or even pay by credit or debit card via irs.gov Pay by Card, though keep in mind that third-party processing fees usually apply for card payments.
Or snail mail.
You can still send a check or money order through the mail, but if you do, be absolutely sure to clearly write your employer identification number, EIN, the words Form 941X, the corrected tax quarter, like third quarter 2024, and the calendar year on the check or money order itself. This ensures it gets applied correctly to the right account and period.
Good tip. Don't want payments getting lost. It's really good to know there are multiple avenues for support and that you're not necessarily left to navigate this entirely alone. Seeking clarification seems way better than guessing and potentially making further errors.
Definitely. Utilizing those IRS resources or consulting with a qualified tax professional who understands these rules can save a lot of time, potential headaches, and importantly, ensures you maximize your rightful tax benefits or minimize your liabilities accurately. Don't hesitate to seek help.
And there you have it, our deep dive into Form 941X. Hopefully transforming its seemingly daunting task into what could be a real financial opportunity for your business. What stands out to you as we wrap up this conversation? What's the main takeaway about reclaiming these potential tax savings and navigating this whole process?
You know, what's truly fascinating here, and I think really empowering for business owners, is that even within the seemingly complex and often intimidating world of employer payroll taxes, there's a structured, accessible process, not just for correction, but crucially for recovery.
It's not just about fixing mistakes, but getting money back.
Exactly. It's not about finding some obscure loophole. It's about proper accounting and diligently utilizing the tools the IRS itself provides. The real power for employers lies in shifting their mindset, understanding that payroll errors aren't just compliance issues that cause headaches. They are very often missed opportunities for significant financial recovery.
Opportunities hiding in plain sight sometimes.
Right. Being proactive, meticulously understanding those periods of limitations, those deadlines are critical, and knowing the strategic difference between an adjustment, line 1, that applies a credit forward, and a claim, line 2, that requests a direct refund. Making those informed choices can directly lead to putting substantial, tangible money back into your business. It's really about turning a potential problem into a definite financial win.
So what does this all mean for you, the listener? Whether you're running a small local shop or managing payroll for a larger enterprise, it means taking another, perhaps closer, look at your past payroll records. Those Forms 941 from the last few years might just uncover some significant tax savings, or at the very least, help you correct an error now and avoid future penalties down the road.
Worth the review.
Don't let the initial complexity of these forms or the thought of dealing with the IRS deter you from exploring those potential financial benefits that are rightfully yours if you overpaid or missed a credit. It's absolutely worth a deep dive into your own records. Until next time, keep digging for those valuable nuggets of knowledge and don't leave your money sitting on the table.